You know, we often think of artificial intelligence as this cold, calculating superbrain that never makes mistakes. We imagine it seeing the future of the stock market in a stream of green binary code, like something out of the Matrix. But let me tell you a story about November 2nd, 2021. That was the day the real estate giant Zillow had to admit that its AI wasn't a crystal ball, it was a money pit. They shut down their Zillow offers division after their algorithm, which was supposed to predict house prices, led them to lose $421 million in a single quarter. This is Fintech Bot Focused, where we discuss, dissect, and implement all things automated trading. If you're into AI tools, bot automation, and new fintech features, make sure you subscribe. Think about that. A company with virtually unlimited data and top-tier engineers lost nearly $500 million because their bot couldn't figure out what a house was worth. So, today we are going deep into the science of market prediction. Can AI bots actually predict market trends? Or are they just really efficient at losing money? We're going to look at the tech, the massive wins, the embarrassing failures, and the one fatal flaw that no amount of code has been able to fix yet. First, let's break down what market prediction actually entails. It's not just guessing if a stock goes up or down, that's gambling. True prediction in the age of AI is about probability and pattern recognition. It's about analyzing volatility, volume, and sentiment. To do this, engineers use specific technologies that sound like sci-fi but are actually running on servers right now. The big one is called LSTM, or long short-term memory networks. Unlike a standard neural network that just looks at data point A to predict point B, an LSTM has a memory. It can remember trends from months ago and decide if they are relevant to what's happening today. It's designed to understand sequences, like the sentence of a news report or the chart of a stock price. And speaking of news, that's the second big tech, NLP, or natural language processing. This is what ChatGPT uses. In finance, NLP bots scrape millions of tweets, news headlines, and earnings calls in milliseconds to gauge sentiment. Is the world happy or scared? And we have proof this works, at least in a lab. On April 13, 2023, researchers at the University of Florida published a bombshell study. They fed ChatGPT thousands of news headlines from late 2021 to 2022 and asked it simply, is this good or bad for the stock price? The result? The strategy based on ChatGPT's answers returned 500% during a period where the S&P 500 was down 12%. So, if a chatbot can get 500% returns, why aren't we all billionaires? Well, let's look at the success stories versus the failures, because the gap is terrifying. On the success side, you have the ghost of Wall Street, Renaissance Technologies. Their medallion fund is the gold standard. Launched in 1988, they were using early forms of machine learning before it was cool. They don't just look at stocks, they look at everything. Weather patterns, satellite imagery, obscure correlations. Their returns? A mind-blowing 66%, annualized before fees. They proved that if you have the best data and the best math, you can solve the market. But then, you have the failures, and they are loud. Let's go back to Zillow. On November 2nd, 2021, they killed their iBuying business. Here's what happened. Their algorithm was trained on historical data. It looked at past home sales to predict future prices. But then the pandemic hit. The market went crazy. The data changed. This is called concept drift in data science. The relationship between the variables changed, but the AI kept trusting the old patterns. It started overbidding for houses, buying them for way more than they could sell them for. When the dust settled, they were holding thousands of homes they couldn't flip, bleeding hundreds of millions of dollars. And it's not just Zillow. Look at the AI-powered equity ETF, ticker symbol AIEQ. It launched on October 18, 2017, running on IBM Watson. It analyzes millions of data points daily. Sounds great, right? But since its inception, it has frequently underperformed the boring old S&P 500 index. It turns out, knowing everything doesn't always mean you can beat the market. This brings us to the role of historical data. It is the fuel for AI, but it's also its poison. AI learns by looking backward. It assumes the future will rhyme with the past. But in finance, the most dangerous words are, this time it's different. This is the ultimate limitation of AI predictions, the black swan. AI cannot predict an event that has never happened before. If you trained an AI on stock market data from 1990 to 2019, it would have zero concept of a global pandemic shutting down the world economy in 2020. It would see the crash coming and think, this is a dip, buy the dip, right before the market falls another 30%. Furthermore, there's the risk of the self-fulfilling prophecy. If every hedge fund uses the same AI models, trained on the same data, they will all see the same sell signal at the exact same time. This could trigger flash crashes where liquidity vanishes in seconds because the bots are all running for the exit together. So, can AI bots predict market trends? The science says yes, but only when the future looks like the past. When the world breaks, the bots break, and as Zillow found out to the tune of $421 million, sometimes human intuition is the only thing that can see the cliff edge coming. Sign up for the Fintech Bot Focused newsletter to stay updated on all things automated trading. AI tools, new automation features, bot strategy, breakdowns, behind-the-scenes market insights, and you can reply with topics you'd like to see covered. The link is in the description. Join our growing community of traders exploring the future of automation. Disclaimer: this video is for educational purposes only. None of this is financial advice. Trading involves risk, and automated trading can amplify that risk. Always trade at your own risk and test everything in paper mode first.